Fuck out of here. So enthused, so happy. I sense sarcasm back there. Is that Maria? That's Maria. But you're so smart. I'm sure you're all intelligent to begin with, but what was that? No. It's Ryan. So we're going to talk about capital gains, specifically more reference to the sale of properties, specifically when it comes to properties that are owner occupied. But then also we're going to touch upon capital gains recognition in the event you sell a property in which it's not owner occupied, so you can understand the tax ramifications. And a lot of people will come and ask you, well, what are the ramifications if I sell my property and I bought in this neighborhood and I have a $3 million gain? What am I going to do, especially if it's my primary residence? Well, we want them to sell. However, the tax ramifications are pretty severe, as a matter of fact. So that's a dilemma. And I don't see this changing in regards to the big, beautiful bill that Trump has proposed. Bless you, John. John's allergic to anything I have to say, obviously. So, with that said, what happens if I sell my principal residence? And this is just for display purposes only, because I'm not going to share all my notes with you. But individuals are generally permitted to exclude from income $250,000 for a single filer, or $500,000 in general for married couples filing a joint return, realized on the sale or exchange of their principal residence. Can you use the exclusion more than once? You can, but you can't use it more than once every 2 years. So keep that in mind. You must have owned and used the property as your principal residence for at least 2 years during the 5-year period ending on the date of the sale or exchange. In addition, the 2-year periods do not have to be continuous. So maybe I moved out, I moved back in, just as long as that 5-year period following or preceding the date of sale, I occupy that property as my primary residence, even though it's not contiguous, that's acceptable. And then there are other things for older people like me that apply, and questions still come up, and this is why I'm going to bring this up to you, as most sellers probably today are a little bit older. But may I use an exclusion in connection with Internal Revenue Service Code 1034, rollover of gain on the sale of my principal residence? If I purchase a home of equal or greater value at one time, you could actually sell your primary residence and roll it over into a replacement property without any tax recognition. But that's been repealed years ago, as a matter of fact. So I just want you to be aware of that. So when that question comes up, you say, no, that has been repealed. It's not applicable to you. And then at one time, there was also an exclusion of $125,000 of gain if you sold the property. That has since been repealed. And even if you used that exclusion before, it doesn't prevent you from using today's exclusion of either $250,000 for a single filer or $500,000 for a married couple filing jointly. Let's see now. And then how does the exclusion apply to married couples? So remember, if it's a married couple, they can exclude up to $500,000 in gain when completing or reporting the income. There are 3 basic aspects. Each spouse meets the ownership requirement, or either spouse must meet the ownership requirement. So if you're married, only one of the individuals that's married must own the property. But both spouses must meet the use requirement for 2 years of occupancy as their primary residence. So only one spouse must own the property. Both spouses must meet the occupancy requirement. And then in addition to that, the other qualification is that neither spouse has taken advantage of the exclusion during the prior 2 years. Make sense? Any questions about that? So what if I marry someone who has used the exclusion within the 2 years prior to our marriage? Well, even though your spouse has used the exclusion within 2 years prior to your marriage, you would still be allowed a $250,000 exclusion. So I remarried, my spouse sold her or his primary residence, and during the prior 2 years, that would preclude me from using the full $500,000 exclusion. But once that 2-year time frame passes, based upon my spouse's sale of their residence, primary residence, assuming they took advantage of the exclusion, because you have no obligation to take advantage of the exclusion. There may be reasons why you may not to. Then you can take advantage of the full $500,000 exclusion. So if you're remarrying and one of the spouses has taken advantage of the $500,000 exclusion or an exclusion, if they're a single filer, then you're only entitled to a $250,000 exclusion. Once that 2-year time frame passes, then you're entitled to the full $500,000 exclusion. And then something else that happens around here, death. If my spouse dies, must I sell our principal residence within a year of my spouse's death to take advantage of the $500,000 exclusion from gain? So you don't have to do that, but if you're going to take advantage of the $500,000 exclusion from capital gains on the sale of your primary residence, you must do so within 2 years following the date of that spouse's death. Otherwise, you will lose the full $500,000 and you will only be entitled to the $250,000. But you still have to meet the 2 of 5 year test, meaning either spouse must have owned the property, both spouses during the 5-year period. I see you laughing. Nothing.
I'm having full enjoyment.
He's buying into the shit that I was saying before we started it, right? Thank you, Ryan. Well, good morning. How are you, Janie? Would you like to sit up front with us? Yeah. Janie's buying drinks, Maria. I want you to know that. Yeah. We're gonna have to make that a prerequisite. Anybody that walks in here after the fact. I'm just joking, Janie. But you can take advantage of the full $500,000 exclusion. You must sell the property within 2 years following the date of death of one of the spouses, which whoever died. But then that spouse who died must have met the requirement that they were either occupying the property or maybe they were the owner of the property and they never used that exclusion previously during the prior 2 years. So when somebody dies, and we probably run into a lot of transactions like that, it's critical that they look at that and take advantage of the exclusion and do so or sell their property within 2 years following the date of death of their spouse. Maybe it doesn't matter to them. So what if I move before I occupied my residence for 2 years, or before 2 years have elapsed since the last time I sold or exchanged my principal residence? So once again, let me just repeat this. I move that before 2 years have lapsed because it takes 2 years of occupancy and ownership. And of course, taking into account the fact that I never use exclusion during that 2 years. Or maybe I just moved out of the property. So I didn't take advantage of the exclusion, or I did take advantage of the exclusion, and less than 2 years have lapsed. What is available to me? So you can take a pro rata amount of the exclusion, as a matter of fact. So if you fail to meet either 2-year requirement, you'll still be entitled to a pro rata amount of the exclusion as long as the failure to meet the requirement is because the sale or exchange is by reason of change of employment, health, or other unforeseen circumstances. So that ratio is the portion of the $250,000 for single filer or $500,000 exclusion equal to the fraction of the 2 years that the ownership and use requirement is met. So let's assume I only lived there for 1 year out of the 2 years. So therefore, an unmarried taxpayer who owns or uses a principal residence for 1 year and then sells because of a job transfer may exclude up to $125,000 of gain, or 1/2 of the $250,000 exclusion for an individual filer. Or if it's a married couple, you could take advantage of a 50% exclusion. So let's see, if we would move down, Carlos, to, I have an example. It's just called example. That's how simple this is. Keep going. And a little bit farther. I have tax schedules up here so everybody can see implications in regards to what the tax ramifications are when you sell property. As a matter of fact, it doesn't matter if it's in regards to property, but any type of long-term capital gains. And I thought I would just review that with you quickly. But an example. So Ms. Seller purchased and occupied her principal residence in 2021. 1 year later, she was transferred by her employer to another city and sells her house for a $100,000 gain. because she occupied a residence for 1/2 of the required 2 years, Ms. Seller is entitled to exclude up to 1/2 of the $250,000 exclusion or $125,000. Otherwise, allowed, thereby covering her entire gain. So the gain on her property is $100,000. She only lived there for 1 year. She met the exclusion. I see this look in your face.
Is this the right example?
It is. It is. At least I thought it was. Ms. Seller? No? No, no, it's just you went too far. I'm sorry. Could you go up? There it is. No, stop.
Yeah, where did it go?
She lived in her property for 1 of the 2 years. She relocated. She's entitled to take advantage of a pro rata portion of the exclusion. She lived there for 1 out of 2 years. So it's a 50% aspect, right? If you multiply 50% times the available exclusion of 250,000, that's the amount, the maximum amount that she can exclude from income. She can exclude no more than $125,000. But her gain on the property in this example was only $100,000. So she can exclude the full $100,000 from taxation. And we have a lot of people leaving California. And of course, there's always qualifications, right, in regards to taking advantage of the pro rata exclusions. Treasury regulations provide clarifications and safe harbors for exemptions from the 2-year period. Treasury Regulation 121-3B provides that a sale or exchange is by a reason of change of employment, health, or unforeseen circumstances only if the primary reasons for the sale or exchange is a change in place of employment, health, or unforeseen circumstances. So the regulation provides safe harbors. And that means, what does that mean? A safe harbor is if you meet these basic requirements, you're no longer subject to litigation or liability if you comply with these aspects of the guidelines, as a matter of fact. So place of employment. If I move after 1 year, just as in our example, and I want to be sure that I'm not going to be subject to any liability from the Internal Revenue Service, there are certain requirements that must be met. So the regulation provides that a distance safe harbor, if the change of employment occurs during the period of the taxpayer's ownership and use of the property, that's the taxpayer's principal residence, and the individual's new place of employment is at least 50 miles farther from the residence sold or exchanged, in addition to the former place of employment. Or, and I'll give you an example, by the way, or if there's no former place of employment, the distance between the individual's new place of employment and the residence sold or exchanged is at least 50 miles. So if somebody's selling their home, they've only lived in their property for 1 year, and they move 100 miles away because of the change of employment, or maybe they weren't employed and they move 100 miles away, they're entitled to a 50% exclusion. So that's considered to be a safe harbor. So let me give you an example. Anju, and she's sitting at the front desk, and she's not leaving, by the way, is unemployed and owns a townhouse that she has owned as her principal residence since 2023. In 2024, she obtains a job that is 54 miles from her townhouse, and she sells the townhouse because the distance between her new place of employment and the townhouse is at least 50 miles. The sale is within the safe harbor, and she is entitled to claim a reduced maximum exclusion under Section 121. So the maximum exclusion is $250,000 for a single filer, but she's moving after 1 year. She's only entitled to 50% of the exclusion. She meets one of the guidelines or the safe harbors that will allow her to exclude up to $125,000 in gain from the sale of her property. And she did that because she's living in the property. That's a requirement. And the new job was at least 50 miles away from where she was residing. And then for purposes of the regulation, employment includes starting a job with the new employer, continuing employment with the same employer, and starting or continuing self-employment. And then health. Let's assume there are reasons that you have dramatic health problems. Well, just because you think it's going to be a better environment for you is not a reason or does not allow you to fall within the safe harbor. But if it's due to facilitate diagnosis, cure, mitigation, or treatment of disease or illness, then you may be entitled to the safe harbor, which would allow you to a certain pro rata deduction or portion to exclude from income when selling your property. Unforeseen circumstances also. So remember, I haven't met the 2-year time frame. This is why this is all important. So what if you're in the way of the bullet train and the state of California decides to condemn your house and they've only been there for 1 year? That is a reason, or that is something that will allow you to fall within the safe harbor, allowing you to deduct a pro rata portion of the gain. Cessation of employment, assuming you meet the guidelines for unemployment compensation, or it could be a court-ordered divorce or multiple deaths, multiple births. There's a big difference there. Okay, look at this more carefully. So there are various reasons, if you haven't met the 2-year time frame, that may allow you to deduct a pro rata portion or the gain up to a pro rata portion of the exclusion that's available. So the exclusion is $250 for a single filer, $500,000 for a married couple. Can I deduct a loss in the sale of my principal residence? Anybody? Just got to one person here. Well, I'll simplify that. The answer is no. You cannot deduct a sale and the loss of your principal residence. If I have gains from the sale of my principal residence above the $250,000 or $500,000 exclusion limits, what tax rate will I pay? Well, depending upon the length of ownership, you may be taxed at more favorable capital gains tax rates. And Carlos, would you just scan down, and I'll talk about this briefly. Keep going to the very last page. 1, 2. Yes. Hi. I didn't even know. I have to look. I know who that is. Hi.
And you mentioned that we cannot have a loss on it.
You can't deduct the loss in the sale of a principal residence.
So at the same time, what is the gain, what is the loss? And
You cannot deduct the sale or offset the loss
not offset.
associated with the sale of a principal residence. No, that's not available, unfortunately. You
wouldn't have 2 principal residents anyways, right?
No, you can't have 2 principal residences. Somebody may have a second home. A second home is almost viewed as a investment property anyways.
If you're married, can one person have a primary and another person have another primary?
No.
Where you don't live together?
If you don't live together, I guess if you're living in it, right?
Yeah, if you don't live together, so you have 2 houses next to each other.
So what's the advantage of that?
I'm not.
It's only 250,000 for each.
At home.
What?
Peace at home.
Peace at home.
People live separately sometimes, like in different states.
I would say that you could each have, well, that's a good question. I don't know why you couldn't each have a primary residence, but of course, you're only going to be entitled to the exclusion of $250,000 upon the sale of their primary residence. You'd have to demonstrate that it's a primary residence. I guess that's a good question, right? And how do you demonstrate that? Well, when you file your tax returns, when you specify your primary residence, those are aspects. And then in California, remember, you're entitled to a $7,000 exemption from your property tax bill, not in regards to the property taxes, but just the evaluation. So you have to claim that as your primary residence to get the $7,000 exemption.
So you only get
the value of the property
on property tax. You don't get the
not off the tax, off the assessed value. So if you have the house is assessed at $1 million and you've notified the assessor it's my primary residence, you're going to pay tax on $993,000. So it's nominal.
Okay.
And then other aspects, where do you live? Which medical professionals do you see? The state of California, they're going to look at which church you go to, who you see for physicians, your dentists. They're going to make a determination if you still live in the state of California. They're going to come after you. They're more diligent than the Internal Revenue Service, as a matter of fact.
The county?
The state of California, the Franchise Tax Board.
Oh, really?
Yeah, they're brutal. Yes.
Have 2 houses in the 2 different cities in California and claim both.
No. One primary residence, you can't claim more than one. And then other rules, special rules and exceptions. So a taxpayer may not wish to take advantage of the exclusion when they sell a primary residence. Maybe one of the 2 somebody remarried and they're moving in with their new spouse. And the gain on the sale of the property they're moving into is far greater than the property that they're disposing of now. So they don't have to take advantage of the exclusion. And if you haven't taken advantage of the exclusion within 2 years, then that doesn't prevent you from taking advantage of the exclusion on the sale of the other property you now claim as your primary residence. So that could take place. Then if you're residing in a nursing home, some of that time could count as you occupying that property as your primary residence. Because remember, you need to meet the 2-year use requirements. One of the spouses must meet the requirement in terms of ownership for 2 years, and you can't have taken advantage of the exclusion during the prior 2 years.
If you live in a state, how many months do you have to live in a home to make it your primary?
I think it's a declaration. That's more the case. Now, in the question that you're asking probably is more,
Because when you travel for work and you're gone 6 months of the year.
then it doesn't matter. It doesn't matter. But I think that's a good question, as a matter of fact, because if you're in the military, that would qualify still as your primary residence if you declare that as your primary residence.
Even though you're.
Yeah, but if you're in the military, and that's common around here, if they've been deployed for up to 10 years, they can still claim the fact that they've occupied this property during that 10-year time frame, so they would be entitled to the exclusion. So there are certain exemptions to actually occupying the property. And then let's talk about the exceptions. And I want to talk about, once again, if in the event a spouse is deceased, so neither spouse to take advantage of the exclusion in the event there's a deceased spouse.
We have a question.
Oh, okay.
What is the difference between a head of household and claiming single? Filing single.
Well, I think it's just the tax status, as a matter of fact, in the tax rate schedule, and we'll look at this tax rate schedules. Head of household, right? So I would say you have children. So that you're going to be taxed differently, just as if you're married, filing jointly, qualified surviving spouse. It's someone whose spouse died in the last 2 years or within the last 2 years. So you're going to be taxed as if you were still married.
Can you read those numbers with a tax percentage compared to income?
The tax percentage, yes, as a matter of fact. So federal long-term capital gains tax rates. So if we look at the very last, the first line item, you will pay 0% long-term capital gains in the end for the IRS if your capital gains fall between a range of 0 to 47,000 for a single filer.
Is that after deductions?
Whatever your capital gains are.
I mean, your income.
This is just capital gains.
Okay.
This is capital gains. So there's a difference when calculating what tax rate you're going to fall into. And when calculating the tax rate, they're going to look at the total income to determine which category you fall into when applying the capital gains tax rate. And not only that, but if you do have capital gains on the very first, let's see, single filer, the very first $47,000 of capital gains, you're not going to pay any tax. But then the next amount between 47,000 and 63,000, excuse me, 47,000 to 63,000, you're going to pay, and that whatever that amount is, that's about $15,000 or $16,000. You're going to pay 15% on that. And then if you fall into the category in which 518, excuse me, I'm looking at that incorrectly, from 47,000 to 518,000, that difference, you're going to pay 15% on that amount. So the rates for the total income that you recognized is going to be varied. You're going to pay 0% on the first 47,000. I'm going to pay 15% on the next amount between $518,000 and $47,000 as a single filer. Then anything above $518,000 in capital gains, I'm going to pay 20% on that amount. So
And that's just for federal.
if I don't, it's just federal, as a matter of fact.
And this is with no exemption, right? This is if you, without
This
the
is after
exemption.
exception.
Well, this is right after exemptions.
Yeah.
after exemption. So you can see how important that
Is
would
there
be. You're
state
selling a
capital
home.
gains tax?
What was that?
There's state capital gains tax.
There is no such thing as state capital gains
Okay.
tax rates. It's just all taxes ordinary income in the state of California.
Repeat that.
In the state of California, there's no exemption for capital gains. There's no different tax rate for capital gains income. You're taxed as ordinary income in anything you do. Yes,
And that's after deduction.
after deductions, correct. That's correct. Yeah, so California is very difficult in regards to how much they impose on you. So there's ordinary income is taxed at a higher rate for federal purposes versus capital gains for federal purposes. State of California, the state of California does not discern between capital gains income and ordinary income. It's all taxed as ordinary income. Yes.
On the house, we consider as an ordinary income?
You're selling your primary residence? No,
No, after 250,000.
no, you would be taxed, yeah, for the state of California. Yes. But for federal purposes, you're taxed at the more favorable capital gains tax rates. State of California, in regards to the exemption, follows federal tax guidelines. So if I have $1 million gain, I'm entitled to a $500,000 exemption because my spouse and I have met the 3 requirements. I'm going to pay tax on $500,000. And here's the tax rates. We're married filing jointly, right? So if we're up to $500,000, I'm going to pay 0% on the first 94,000. I'm going to pay 15% on the amount between 94,000 and 583,000 on $500,000 in my example. But in California, it's just going to $500,000 is all going to be taxed as ordinary income.
Yeah.
And our legislators are talking about increasing our taxes because there's a $12 billion deficit. Oh, surprise!
Who's getting that money?
Who's getting that money? I don't even want to get into that. That's
Let's not go down that road.
right. Don't get me started. $12 billion, right?
1%.
That's a lot. That's a lot of money, isn't it? I live off of much less.
Thank God.
Yeah.
Because you're making 12 million, right?
Yeah. I wouldn't be here if I was making $12 billion. Huh? However, I'm still working every single day. So what happens if I transfer my principal residence into revocable trust? Well, the Internal Revenue Service Code provides that a grantor, the person who creates and funds the trust, is treated as the owner of the property when the grantor retains the power to revoke the trust and revest the title on him or herself. So that means I've created a family trust. I own the property as Richard Moore. I put it in my family trust. I'm still the owner. I'm the grantor because I have control of that property and I can transfer it back to my name individually. I'm entitled to the $250,000 exclusion as a single man. So there's no tax implications associated with that.
Are you going to send out that form right there or that piece of paper?
You want me to send that out to you?
Email?
You're going to be the very first person I send that to.
Really?
Of course. No humor in here.
Oh, you found so funny.
I'm so funny, right? You asked me if I wanted to be a stand-up comedian, man, remember? I wasn't sure where you're going with that, but
I really want it.
it's very nice. So can I utilize an Internal Revenue Service Code 1031 like-kind exchange in connection with an owner-occupied property? Correct, you cannot. Good answer, Ryan. However, individuals exchange one rental property for another planning to move into the acquired property. So that's permissible. And after living in it for 2 years and sell it, they want to sell and take advantage of the capital gains exclusion. So a property acquired in a 1031 exchange and later converted to a principal residence must be owned for 5 years from the date of the exchange before the owner can claim the capital gains exclusion. So therefore, to take advantage of a 1031 exchange and capital gains exclusion, the owner must both have used and acquired the property as the principal residence for 2 years and owned it for 5 years.
So when they transfer a 1031 to a new rental property,
Mhm.
how long do they have to wait before it's a rental property?
That's a good question. So that's the other qualification, as a matter of fact. You must, the safe harbor is that you must have rented their property for 2 years.
2 years.
I suggest no less than 1 full calendar year. So I bought a property, it's a rental, I convert it into a 1031, or actually I sell it and I buy an investment property after I sold that, so I've completed a 1031 exchange. My intent is to move into that property. I have 3 different obligations I must meet. Before I can take advantage of the $500,000 exclusion if I'm married, I must have owned that property for 5 years. I must have occupied that property for 2 years, and I must have rented that property for 2 years to be safe from any implications associated with the IRS. So you can do that.
So this is for the investment property.
Yes.
But if I buy a house today and roadside, and 2 years from now I sell it, I still have to buy this house.
Right. If you buy that property and you live in it for 2 out of the last 5 years, you can take advantage.
No, not there. You know, the 5 years
Mhm.
would apply to a primary residence, or it just for the investment property?
Well, we're talking, in this example, we're talking about selling an investment property, acquiring a replacement investment property, and my intent is to convert that to a primary residence. Yes. So it must have been rented for 2 years. I must live in it for 2 years, and I must own it for 5 years before I can take advantage of the exclusion when I sell their property.
But when Richard did the exchange, that would be residential or it would be rental?
It doesn't matter.
That's-
Well, when we say there's a difference, you said residential, now we're talking about investment property.
Yeah.
So investment property can simply be residential, and that's really what we're talking about. Residential investment property. So it's a great opportunity for anybody, if, with proper planning, to take advantage of deferring the gain on the sale of the property, that investment property, rolling it into a replacement investment property, then ultimately moving into it as your primary residence. And just think, if you move into that as your primary residence, you're not going to pay any tax.
Question. Mike Dunn, Capital Gain News. So, as an example, let's say somebody lived in a property for 10 years as their principal residence. Then they started renting it for another 10 years. And then now they want to move back into it. The prior 10 years, every year they did a depreciation.
Yes.
So when you move back in to make it your principal, you have to give all that back, or?
No, actually, there are interesting guidelines in that regard. And January 1st of 2009 is a cutoff point, because here's what takes place. Beginning January 1st of 2009, the time I lived in a property, or a property that was an investment property, or any property as a matter of fact, is deemed to be qualified use. Anytime that I rent that property, it's deemed to be non-qualified use. Anything before January 1st of 2009, it's considered to be qualified use. And what is qualified use? It's me owning and occupying that as my primary residence. Non-qualified use is a duration of time which I have rented that property out. So it's a very interesting form, and I'm glad you brought that up, because I've got a number of examples, Mike, to address exactly what you're talking about. Roya, did you have your hand up?
Yeah.
Okay. And so I will go through those examples, Mike, because those are really good questions. And I think we see that a lot, as a matter of fact. Let's see. We're going to talk about that right now, as a matter of fact. So let's address how capital gains exclusion is treated differently for the sale of a principal residence that was used as a second home or as income property during the ownership period. So once again, and your time is perfect, Mike, for any periods of ownership occurring on or after January 1st, 2009, the exclusion from capital gains recognition will be reduced by the amount of time the property was not used as a principal residence, and that's also non-qualified time. So if there's a period of time in which it was not occupied as a primary residence, it's going to reduce the amount of the exclusion I could take advantage of. Right? The gain from the sale will be allocated between periods when the property was used as a principal residence, which is qualified use, and periods of non-qualified use, the time in which I rented the property out. The math is as follows, and let's see, we do have an example here. Carlos, could you just move the screen up, please?
Is this the one?
Yes, this is the one. This is the right one. So this is exactly what I'm talking about. Thank you. So the math is as follows. The gain is multiplied by a fraction where the top number or the numerator is the period that the property was used as a principal residence, which is qualified use, and the lower number, the denominator, is the total period of ownership. So in Mike's example, he talked about periods of time in which the property was owner occupied and periods of time in which it was rented. We can only take advantage in terms of the exclusion, we're entitled to a pro rata portion of the exclusion. So the formula is the gain, whatever the gain of the property is, times the amount of times the qualified use divided by the total time that the property was owned equals the exclusion from capital gains. And once again, it's still going to be capped at $250,000 and $500,000. So let's go through an example. A married couple filing jointly purchased a vacation property on January 2nd, 2012. Which they sell on January 2nd, 2020 for a gain of $600,000. During the last 2 years of ownership, they occupied the property as their principal residence. They would divide 2 years of qualified use. That's how long they owned and occupied the property, or actually occupied the property, by the total years of ownership, which is 8 years, and then multiply that by their gain. So they could exclude up to $150,000 from capital gains, which is less than a $500,000 cap. And the balance of the $600,000 gain, the $450,000 would be taxed as capital gains. So I bought the property. I rented it for 6 years. The last 2 years I occupied it. I'm entitled to 2/8 of an exclusion of the gain, not to exceed the $250,000 or $500,000 cap. So we can do that, all right? Let's move on to the next. Any questions about that? Because I have other examples to address that. You move on to the next. There we go. Perfect. So remember, qualified use is the time that I not just own the property, but I occupied it. Non-qualified use is the time in which it was rented out. But there's an exception. There's always exceptions. So to qualify for the exemption of $500,000 and $250,000. Remember, the obligation is to have occupied the property for 2 out of the last 5 years. But if it's a 5-year time frame of ownership, the 3 years following the 2 years in which I've occupied the property, that 3 years will be deemed to be qualified use. So I bought a property, I lived in it for 2 years, I rented it for 3 years, and as long as I sell within that 5-year time frame, the following 3 years will allow me to take advantage of the full exclusion. So there's no reduction in regards to the exclusion that's available to me. So that's one of the examples. However, if I bought a property for 2 years, or I bought a property, I lived in it for 2 years, I rented it for 3 years, and then I moved back into it in year 6 for 1 year, now I'm not entitled to the exclusion. And I've got an example for that also.
Question. 250 and 500 numbers are old. Shouldn't the numbers be higher now the prices are much higher?
It depends who you vote for. You know, but where I grew up in Ohio, these numbers are astronomical, and it's I think that's what it's appealing to. It's probably 2/3 of the country. That's why we keep hearing now about the changing the SALT tax, the state and local tax deduction. Well, most of the states in this country will never meet the thresholds of 10 or 20, or what is it, $10,000 for state and local tax deductions. So that's what everybody's arguing about right now. There's only a few states, these blue states, California, New York, for example, possibly Illinois, maybe Washington. All these states want to have these caps listed or lifted so you can deduct all your property taxes, state and local income taxes, but it's then subsidizing the state in which you live in. So that's a debate. But I think that's a very good question. So who are we going to vote for, right? Let's see. And then let's go to example 2, Carlos.
It's a
Oh, thank you. So January, these are all very similar. 2009, January 2009, married taxpayers filing a joint return buy a house and use it as their principal residence for the first 2 years. They then convert the residence to a rental for the next 3 years, after which they sell the residence and realize a gain of 600,000. None of the 3 years of otherwise non-qualified use after the initial use as a principal residence would be used to reduce the capital gains exclusion. They would be entitled to the full $500,000 exclusion and would owe capital gains on $100,000. So remember, the 3 years following the 2-year ownership period will be deemed to be qualified use. If you go beyond a total of 5 years, you may lose the exemption. But if I buy it, I move into it for 2 years, I rent it for 3 years, I'm entitled to the full $500,000 exemption as a married couple. In year 6, if I rent it or I move into it again, suddenly now I haven't met the requirement. So I may lose entitlement to that exemption. The period of time before occupying the property as a primary residence is deemed to be non-qualified use. So that's going to reduce the allowable exemption to me. Now, why are we going over this? Anybody know? Because people have questions and they want to know what happens. I've moved into this property, I want to do all these things. So your response should be, that's great. You may be entitled to a full exemption, or you may be entitled to a partial exemption. So I want you to speak to your tax professional so they can understand, or you can understand exactly what the tax consequences are. But at least you're in tune with what's taking place out there. You don't want them to say, oh, you're entitled to the full exemption because you lived there for 2 years. They may not be. Yes.
So if they rent it out for 1 more year, it'll be 4 years, they rent it out in 2 years, they stay, it'll be 2 divided by 6.
Well, let's say they bought it, they rented it, they lived in it for 2 years, they rented it for 4 years. Now they haven't met the 2 or 5 year requirement to take advantage of the exclusion. So they lose the total of the $500,000 exclusion in your example.
Right.
You're listening, that's good. So the timing is critical. It's very critical. And this may address some of it. So the same couple buys a house in January of 2009 and rents it out for 6 years. They then occupy it as their principal residence for 2 years and sell it for a $600,000 gain. Since none of the 5-year qualifying ownership period occurs after the 2-year qualifying use period, only the last 2 years of occupancy count as qualified. So in this case, they would only be entitled to 1/4 of the exclusion. And the formula would be 600,000 times 2, which is the total years that they occupy the property. Because remember, the last time they occupied the property, or out of the 8 years of ownership, it was at the end of the ownership period. So the very first 6 years are non-qualifying periods.
We're in example 3 now?
We're in example 4. Sorry, should have asked you to move forward. No wonder you look puzzled.
Yeah, like that's.
Yeah, that's fine. So we bought it, we rented it for 6 years, we occupied it for 2 years. I'm only entitled to 2/8 of the exemption. So you can see how it affects people negatively. One more example.
It's because it's not 2 years, but 5 years, right? It's 2 years, but 8 years.
No, in this case, the rules are any of the time frame following the initial 2 years of occupancy, no more than following that, no more than 3 years, will be qualified or counted as qualified use. Well, I can occupy it for 2 years, and if I rent it out for the subsequent 3 years, those subsequent 3 years are qualified use, meaning the IRS looks at it as if I've occupied that property. But any period preceding the time frame, which that 2-year time frame is met, is non-qualified use. So it reduces effectively on a pro rata basis the amount of the exception that you're available.
So 3 years good.
Exclusion is available.
Yeah.
4 years is bad, exactly. So 2 years occupancy, I can rent it for 3 years. I'm entitled to, but in another example, so if I own it for 10 years, say I bought it for first 5 years I rented it, I occupied it years 6 and 7. and then I rented it out for years 8, 9, and 10, I'm going to be entitled to a 50% exclusion of capital gains. First 5 years are non-qualified use. The 2 years I occupied it are qualified use. Anything falling within a 5-year time frame, beginning when I began to occupy it, within a 5-year time frame is considered to be qualified use.
So you have to live in it for 5 more years. If you rent it out for 5 years, you get the full amount.
No, you don't have to rent it out, but you don't have to live in it for 2 years. But you need to, once you live in it for 2 years as your primary residence, don't rent it for more than 3 years. Otherwise, you're going to lose the possible exemption.
Even if you rented it 5 years before.
Right, you already are losing the 5-year portion of the exemption based upon a pro rata portion. In my example, I just simplified it, right? 5-year rental, total ownership period of 10 years. So I would lose 50% of the exemption in that
My
example.
clients talk to you if they have any questions.
Don't have them talk to me. It's okay, yeah.
Start with if I own it for 15 years,
15, yes, okay.
the last 13 years I was renting it, and the last 2 years I was living in it. So do I get that full exclusion?
So you owned it for 15 years, all right? When did you move into it as your primary residence?
2 years ago.
So 15 years ago, you bought the property. And then 2 years ago, you lived in it for years 14 and 15.
Yeah.
So you're going to be entitled to the pro rata portion equal to 2 divided by 15 times the gain.
So if the rule is just 5 years, anything after 5 years, you will use it.
Not necessarily true. It just, the guideline is beneficial for you. If I occupied it for 2 years in my primary residence, there's 3 years following that. If I rented it out, it's considered to be owner occupied. But if I go beyond that 3-year time frame, I lose then the exemption.
In my exam,
Makes sense. You start.
for 2 years, but the last 5 years, I was 2 out of the last 5 years.
But that's fine. 2 out of the last 5 years. Well, was it years 11 and 12 that you occupied the property?
Doesn't make any.
Yes, it does. It makes a big difference.
difference.
It makes a big difference, yes.
So it should be in the beginning.
If I live in the right, well, any period of time that it's not owner occupied can be qualified as owner occupied use if it's only 3 years following the time in which I actually occupy the property as my primary residence.
Before.
If it goes into 4 years, suddenly that benefit is no longer available. So in your example, I bought it 15 years ago. I moved into it in years 11 and 12. I rented it for years 13, 14, and 15. So years 13, 14, and 15, because it falls within the 5-year time frame following the 2 years of which I occupied it, are going to benefit you in regards to the exclusion. So I could deduct up to 5/15 of the gain when filing my tax return.
How many years I have it? It has to be more than 5, but the first 2 years I have to live in it.
No, the 5-year time frame only applies if I have an investment property and I roll it into a 1031 exchange, through a 1031 exchange, and I buy an investment property and I want to convert that property into my primary residence, then that's a different application. So in that regard, for me to take advantage of the exclusion, once I roll it into an investment property, I have to have owned that property for 5 years. I must have rented it for 2 years, and I must have occupied the property for 2 years to take advantage of the $500,000 exclusion.
So this one is different than that?
It is different than this. Yes.
What way?
Well, I think it's just the guidelines. To avoid taxation, the technique is if I want to take an investment property, roll into an investment property, and that investment property is one that I want to occupy for the rest of my life, to do that, and I'm never gonna sell it, then I would actually own it for 5 years, at least before I sell it. Or you won't incur any tax, as a matter of fact, in my example, if you sell an investment property, buy a replacement property through 1031 exchange, and then just as long as I rent that replacement property for 2 years, I can convert that to my primary residence as long as I don't sell it. I will never pay any capital gains tax. And nor will there be any depreciation recapture on that property.
Nor will your kids if you leave it.
So, well, then if you die, that's the benefit, right? Your kids are going to benefit because they'll get a property based upon the value as of the date of death. That's going to be their basis. And they'll never have to pay tax in terms of depreciation recapture. Because remember, any depreciation that you've taken, you're going to be taxed at a federal rate of 25% of the depreciation taken if you do sell an investment property. And that's substantial.
My other question is that I know of some people that they do have a house in California and they do have a house in Arizona because of the estate tax. And so if they want to sell their house here, it doesn't apply to them the 500,000 because they are filing the tax.
No, the $500,000 is from, that's a federal guideline. So it applies to them. And California conforms to the same guideline in regards to the $500,000 exclusion. But in regards to your client's aspect, the fight's going to be between the states. Where do they live and who's entitled to any benefits the state may derive upon the sale of the property. So the state of California may say, hey, you're still a resident of California. You need to file a California tax return. But for federal purposes, the same guidelines apply no matter which state you're living in.
It sounds like you benefit most if, say, this primary property is bought within, you buy it, live in 2 years, sell within 3 years, renting after before the 5-year mark. But if you go beyond that, even if you move back in, you kind of lose it because now you're getting a portion.
You got to start the time frame all over again.
Years 6, 7, I move back in. Then years 8, 9, I rent it out, right? Do I get the full 500 or 250, 500, whatever?
No, we're going to go back, unfortunately, and we're going to look in that scenario. We're going to look at the time that it was rented. We're going to determine whether or not, or what the pro rata portion is in regards to the exclusion.
Right, so now it's a percentage because you're the
Yes.
ownership in that. So if you want to maximize, it's best within that first 5 years.
Yes. So the best thing to do, something I didn't do and I regret not doing, for my primary residence, I wish I would have sold my property every 2 to 5 years to take advantage of the $500,000 exemption. Because the gain, I had to pay, unfortunately, a gain on the sale of my property after living in it for 20 years. But if I rolled it every 5 years or every 2 years, I could have deducted $500,000 from the gain on the sale of that property in every single instance as my primary residence. I think, pardon me?
I got it. And
Yes.
then on the second portion, where you're talking about like the investment property sell it 1031 to the new property, but that's your investment. Basically, that's the situation. I 1031 the property, I live in it though, but a company rents it for me. So I can rent it for 2 years, then I can convert it over to a primary as long as I don't sell it and it's to my kids.
Right. You have to, if you want to sell it to take advantage of the capital gains exclusion in your example, you'd have to have owned that property, the replacement property, for 5 years.
Okay. And then I can sell it.
Then you can sell it. Exactly. Take advantage of the $500,000 exemption, assuming you're married.
The gains amount, is it from the amount that I bought it, when I replaced it, or when I actually sold it? Like,
Well, when you remember in a 1031 exchange, you bought you bought the original property for $1 million. You rolled it into, and you have a gain of $1 million. So let's assume then the replacement property is $2 million. That gain is of $1 million just deferred. So it's going to be, let's assume that the property never appreciates within that 5-year time frame. Out of the $1 million gain in my example, you're going to have an exclusion of $500,000 and pay tax on $500,000.
Oh, So original gain.
The gain, yes, exactly. But that's assuming that the replacement property doesn't appreciate. Right?
So the placement property appreciates, let's say, 500,000, then it covers that and then you still owe taxes.
A tax on $1 million that you carried forward in the 1031 exchange, exactly. So let's just go over a couple of things. That's the other thing that I wanted to mention. So we know if you go to, keep moving up the schedule here. Keep going. We talked about that one already. So this, stop there, please. This just gives you an idea that if you don't meet the capital gains tax requirements, you must own any type of investment property for 1 year to take advantage of the more favorable capital gains tax rates. This is the tax rate you're going to pay on these different income levels for federal purposes, as a matter of fact. So it's a substantial penalty. So obviously, any investment property you own, whether it's stocks, property, if you sell it before a 1 year time frame, you're going to be paying taxes at a much higher rate. So I just wanted to point that out. Yeah.
So like a flip or something.
Yeah,
I
exactly.
need something that one.
Sure.
Can you give me an example of a Prop 19 property?
Prop 19.
That's
Oh.
over there.
Taxes are taxes, right?
Property taxes.
The government's taking some.
No, that's
Everybody's
this.
taking something.
I have to admit that is a far different question than what we're talking about today. So Prop 19 has nothing to do with federal income tax or state income tax or capital gains. It just, what was that?
The government always gets something.
Yeah, well, they always come. Yeah, that's right. Exactly. I'll talk to you about that afterwards. How's that? Yeah, special session, as a matter of fact.
That is not.
So we know if you're selling an investment property in less than 1 year, you're going to be taxed at these tax rates. So I just want to mention that to you, and I'll send the schedule out to everybody. And then in addition to that, would you go to the next schedule, please? The other tax that applies to the sale of any investment property is net investment income tax or Medicare tax. And that's going to be based upon 3.8% of the net investment income. And there's different thresholds. So when determining the 3.8% that a person's going to be paying, it's going to be the 3.8% is going to be based upon the lesser of the actual net investment income. So if I own a rental property, what's my net investment income? I collect rents of 100,000. I have expenses of 40,000. I have depreciation of 20,000. So my example of $40,000, that is net investment income. So I could be paying 3.8% on that also in regards to my tax return. Or if I sell a property, also I could be paying 3.8% on the gain on the property. However, you're going to be paying 3.8% on the lesser of the net investment income or the amount exceeding modified adjusted gross income. So I just want to go over this quickly. But when someone's asking you, what am I going to be paying when I sell my property, they could be paying an additional 3.8% on the gain of the sale or property. But it has to be a comparison between the amount over these thresholds, based on single, head of household, married, family, jointly, versus that of the actual net investment income. So they could be paying additional tax besides just capital gains. Keep that in mind. So they should be talking to their tax preparer. That's very important, as a matter of fact. Or you can consult me for $1,000 an hour.
You got out of it.
Hey, you know what? Inflation. And then we're almost done here. Let's go to the next schedule. We're just about done. And then capital gains tax rates. When you sell a property that you've held for investment for more than 1 year, here are the tax rates. So the very first 47, the first single filer, very first $47,000 of gain will be taxed at 0%. So if you're selling equities or anything else, structure it. Make sure your capital gains are $47,000 or less. So you're not paying any capital gains tax on that, right? Why not do that? And then after that, unfortunately, between 47,000 and 518,900, you're going to be paying at a rate of 15% on that gain. And then above that, 20%. But you could also be paying 3.8%, plus you're going to be paying state income taxes, as a matter of fact.
the head of household, does having a pet count?
In your case, you have two pets. I'm sure it qualifies, Rob.
No, I gave them away.
You what?
Yeah, I gave them pound.
Then remember, one other thing when selling investment property or real estate, when you sell that property, not only may you be taxed at capital gains tax rates or as ordinary income, but then any depreciation you've taken is taxed at a rate of 25% for federal purposes. So if you depreciated a property and you've taken $100,000 in depreciation when you sell their property, you're going to be paying an additional $25,000 in depreciation recapture. Crazy. So that's the end of my discussion. Any other questions before we conclude? Hi, Mike.
Question regarding the 250 versus the 500. Let's say somebody's single and they own a property for 5 years and then they get married and then they sell. Do you have to own it as husband and wife for a certain amount of time?
No, the ownership as long as one of the spouses has owned it for at least 2 years. But to take advantage of the full $500,000 exemption in your example, they both must occupy the property for 2 years.
Okay.
And
So, yeah.
won't be on title.
No,
Yes?
No.
They don't have to be
no,
on title?
only one person must be on title.
Okay.
Just the occupancy aspect is what's critical.
They just have to file jointly if they're not.
Yeah, they have to file jointly. Yes, that's critical. They must be
2
filing.
years.
No, just as long, in Mike's example, somebody owned it for 5 years, they got married, and then the new spouse moved in, just as long as they occupy the property together for 2 years, that's all that matters. And it's always been and it's their primary residence, then they can take advantage of the $500,000 exclusion, assuming the spouse that moved in did not take advantage of the exclusion within a period less than 2 years. So they would just wait, I would think, to get the full $500,000 exclusion.
But you said they have to file joint
They have to file jointly.
for the last 2 years? Or just-
No, it just doesn't matter. As long as they're filing jointly, that's all that matters at that point in time. No, correct. The new spouse must not be on title, only one spouse. I've got my first client here. It's all free. That was a good question. Any other questions before we conclude? No, Ryan wants us to end.
There's only so much I can.
I know, well, hey, yeah, I know. Like I said, you're gonna walk out of here enthusiastic. What could be more exciting than taxation? You know what's exciting? Taxation avoidance. That's what we're trying to talk about here, right? Just trying to avoid any taxation. Great. Well, thanks for coming, everybody. I really appreciate it.
Can you?
Oh, no. Can you turn your cards in? We do have a drawing. Oh, Ryan's the first one up here. Ding. Anybody else?